Good morning, everyone. Today we're going to be looking at reviewing the assignments. Remember last year we did the Jan, Feb, and the May, June 2023 papers. So today we're going to be reviewing the assignments. We're going to start with assignment 1. Then when we're done with assignment 1, I think in the next class we should look at assignment 2. Once we're done with that, that's when we're going to move on to looking at practice questions as well. So if there's any other questions that you have on things that you've come across when you're doing revision, we're going to be addressing them after we're done with assignment 2. So please make sure that if there's anything that you come across that you're finding difficult or that you're not sure exactly how to handle as well, when it comes to Fin4802, can you just please send me a picture of the question or tell me exactly where the question is so that I can be able to share the question, so that in the class after we're done with assignment 2, we'll be able to look at those practice questions as well, so that we polish up on any other topics which are outstanding as well, or which we're having issues with. So today we're going to be looking at assignment 1, and looking at assignment 1. Assignment 1, question number 1, they give us that information. So for question number 1, for 1.1, they ask us if the interest rate parity is holding, and you may ignore transaction costs. So we need to check to see if interest rate parity is holding. So to check if interest rate parity is holding, it means this relationship should hold, right? Where we say 1 plus the interest rate in the domestic currency should be equal to so 1 plus the interest rate in the domestic currency should be equal to the forward rate over the spot rate multiplied by 1 plus the interest rate in the foreign currency. So which means if interest rate parity is holding, this side should be equal to that side. So if interest rate parity is holding, this side should be equal to that side. So which means if you check on the information that they give us, you'll see that remember they tell us that the spot exchange rate is this for per US dollar, and then the forward rate is this as well, and then they give us the 1 year dollar interest rate, and then they give us the 1 year CHF interest rate as well. So which means in this case, our interest rate being our domestic being the US dollar, it basically means that we need to now check to see if what the domestic side is also equaling the foreign side when you adjust it for what, for the forward rate, and also when you adjust it for the exchange rate as well. So which means in this case, it would mean when you compare the two sides, we should be, when you compare the two sides, it would translate to 1 plus the interest rate on the dollar side should be equal to the forward rate over the spot rate multiplied by 1 plus the interest rate on the CHF side. So which means in this case, we The interest rate on the US dollar side is equal to 1.25%. So as the decimal is going to be 1 plus 0.0125. And it should be equal to, on the information that they give us, the forward rate is 1.1922. And the spot rate is 1.2051 multiplied by 1 plus the interest rate in the foreign currency, in this case, which is the CHF, is 3.75%. So it's 0.0375. So on the left-hand side, we get 1.0125. So if you do the calculation there, how much do you get on the right-hand side? So if you do the calculation, how much do you get on the right-hand side? How much do you get? So how much do you get? So on the right-hand side, how much do you get if you do the calculation?
I get 1.0263.
Yes, but it's 639, isn't it? So if it's 639, what decimal places, it would be 1.0264. Please note that the normal accepted practice is that when you do your in-between calculations, you round off 4 decimal places. Then when you do your final answer, depending on exactly what you're calculating as well, you round off to 2 decimal places, unless otherwise stated. So unless otherwise stated, that's the norm. When you do your in-between calculations, you round up to 4 decimal places. Then your final answer to 2 decimal places, unless otherwise stated as well. So which means that if the question specifically asks you to round off to a certain number of decimal places, then you do that. So what do we see here? The left-hand side is not equaling the right-hand side, isn't it? So if the left-hand side is not equaling the right-hand side, it means the interest rate parity is not holding. So the moment you see that the left-hand side is not equaling the right-hand side, it means the interest rate parity is not holding. Are we on the same page? Any questions? Please excuse my voice. I have a throat issue, but I'm hoping that it will fade away. We'll move on to question to 1.2. For question 1.2, they give us, remember, if you check on the way that the lecturer also did the calculations as well, you will see that the lecturer says it's either you do this method or you do this other method where you do the indirect method as well to check to see if interest rate parity is holding. Then after that, if as you see that the left-hand side is not equaling the right-hand side, it basically means what? The interest rate parity is not holding. So if they say, because the interest rate parity is not holding, there is an arbitrage possibility. So also that's 1.2. So because the left side and the right side of IRP are not equal, the interest rate parity is not holding. Yes, is there a question?
It's a college.
Is there a question? Please put your microphones on mute. So which means if the left-hand side is not equaling the right-hand side, it means what? The interest rate parity is not holding. Now, the second part of the question, they now ask to say, for the second part of the question, they also ask and say, is there an arbitrage opportunity? And if yes, show what steps needed to be taken to make arbitrage profit. Assuming Charles Naidu is authorized to work with US $1 million, compute the arbitrage profits in dollars as well, right? So to see now which steps you need to take to check to see if there's an arbitrage opportunity, it means that we now need to check to see exactly, so which means to make that decision, we are going to say, to make that decision, we're going to say, so on your T diagram, we have the US dollar side and we have the CHF side. So on the T diagram, we have the US dollar side, we have the CHF side, right? So from the given information, from when you look at when you look at our diagram, we see that the smaller amount is on the US dollar side, and the bigger amount is on the CHF side. So the smaller amount is on the US dollar side, and the big amount in this case is on the CHF side. So because of this, it means we are going to make a decision to what? Borrow on the US dollar side. And if you borrow on the US dollar side, it means you do the opposite of the other currencies, which you're going to invest on the CHF side. So because the left side is the one that is smaller, we're going to borrow on the US dollar side. And because the CHF side is the one that is bigger, we're going to invest on the CHF side. So we're going to borrow US dollars, and then we're going to invest on the CHF side. So which means now, when you look at your T diagram, we are saying you on day 0, you are going to borrow, you're going to borrow 1 million. So you're going to borrow 1 million, convert it to what? CHF currency, invest this money. If you check on the period, it's what? Over a 1 year period, isn't it? So which means you're going to invest this money for 1 year. Then after 1 year, you convert this money back to US dollars. So that's the strategy that we're going to follow. Borrow on the US dollar side, convert to CHF, invest it for 1 year, and then convert it back to US dollars. Then now when you borrow on the US dollar side, it means after 1 year, the loan plus interest is due. So on the US dollar side, it means after 1 year, the loan plus interest is due. Is there any question so far on how we have come about with this particular T diagram? Remember, in the exam, you don't get marks for the T diagram, but you are doing it as your separate calculation, or as a separate working, so that in your mind, you're basically drawing a mind map, so that you know exactly where are you going and where are you going to return, where are you going to end up as well when it comes to what? Your calculation as well. Are we on the same page? Any questions? So which means now, on the steps to take now, it means that On step number 1, we're going to borrow 1 million US dollars. We're going to borrow 1 million US dollars for 1 year. And now remember, the interest in US dollars is 1.25%, isn't it? So we're going to borrow at 1.25% per annum. That's the first step. Now, remember what we see as well. If we borrow 1 million US dollars, what's going to happen? We need to pay back the loan plus interest after 1 year, isn't it? So which means you need to pay back loan plus interest we need to pay back the loan plus interest after 1 year. And the loan plus interest that we need to borrow, pay back in this case is going to be, remember we're borrowing 1 million, in brackets 1 plus. The interest rate is going to be 1.25%, so it's 0.0125. So in this case, how much do we need to pay back after 1 year?
$1,012,500.
It's 1 million?
0.12,500.
0.12,500. So that's the amount that we know that we need to pay back, is it right? The next step, we said, with this money that we've borrowed, we need to convert it into what? The CHF currency, isn't it right? So which means in this case, we need to convert, step number 3, convert US dollars to CHF at what? Spot rate, isn't it? We need to convert US dollars to CHF at spot rate. And we are converting an amount of what? 0.12,500. But now, when it comes to conversion, we know that the spot exchange rate is the spot exchange rate in this case is equal to CHF $1.2051 per US dollar, isn't it? So if you look at these two currencies, which currency is stronger? So if you look at these two currencies, which currency is stronger? Is it the US dollar or is it the CHF currency? Which currency is stronger here?
The dollar.
The dollar is stronger, isn't it? Remember we said the stronger currency is the one that you need less of, isn't it? So when you look at the exchange rate or the exchange there, right? The stronger currency is the one that you need less of. So which means when you look at this particular exchange rate, we need less of the US dollar compared to the CHF currency, isn't it? So which means in this case, the strong currency is the US dollar. So in this case, we are moving from the stronger currency going to the weaker currency, isn't it? So no matter what you do, your decision on whether you should multiply these units or you should divide these units is dependent on exactly where you're going. So you know when you're moving from a stronger currency to a weaker currency, you should end up with what? More units. So when you're moving from a stronger currency to a weaker currency, you should end up with what? More units. So for us to end up with more units, given this exchange rate, should we multiply or should we divide?
multiply.
So in this case, we should multiply by the exchange rate of 1.2051. So in the CHF currency, how much do we end up with?
Sorry, Rhinos. Are we not converting the 1 million?
Oh, yes,
Without
yes.
the
Yes.
interest.
Sorry. Yes. It's with the 1 million without the interest. Sorry about that. It's the 1 million without the interest. Sorry about that. It's the 1 million without the interest. Because remember, the 1,012,500 is the loan plus interest after 1 year. Yeah, it's the 1 million. Sorry about that. So the 1 million units at 1.2051, how much do we end up with?
One 205,100.
1,205.
205,100.
So that's how much we end up with, isn't it? In the CHF currency. And our next step now is to invest this money for 1 year, isn't it? So step number 3, or step number 4, invest proceeds in CHF for 1 year at an interest rate of, in CHF, if you invest money, we earn an interest rate of what? 3.75%. So which means we're investing an amount of 1,205,100 in brackets 1 plus. Our interest is 0.0375. So how much do we end up with?
One 250,291.25.
1,250,291.25. 1,250,291.25. So that's how much we end up with. Next, step number 5. We now need to convert this money back to US dollars, isn't it? And remember, we're going to be converting this money back to US dollars at the forward rate of how much? At the forward rate of CHF 1.1922 gives you $1. Now, what do we see? We are now moving from the CHF currency going to the US dollar. So we are now moving from the CHF currency going to the US dollar, right? So which means in this case, we are moving from the weaker currency going to the stronger currency. So which means we're moving from the weaker currency going to the stronger currency. And if we're moving from the weaker currency going to the stronger currency, we end up with what? Less units, isn't it? So when you're moving from the weaker currency going to the stronger currency, we end up with what? Less units. So which means in this case, we are going to sell CHF 1,250,291.25 at the forward rate. So we're going to sell that amount at the forward rate, right? So which means we're selling 1250,291.25. Now we're moving from the weaker currency going to the stronger currency. So do we multiply or do we divide by the exchange rate?
We do the reverse, we divide.
So we're going to divide by 1.1922.
922.
So how much do we end up with in US dollars?
One 1,048,726.09.
726.09.
26.09.
And step number 6, we need to now, we are here with our investment proceeds. We also have our loan and interest due, isn't it? So which means our arbitrage profit in this case is equal to, so our arbitrage profit is equal to the difference between our investment proceeds of 1,048,726.09 and our loan plus interest due, which is an amount of 1,012,500. So how much is our arbitrage profit? How much do you end up with?
36,226.09.
So end up with 36,226.009. Are we on the same page? Any questions? Is there any questions or anyone lost? Now we are arriving at the final answer. So if you check on the lecturer's memo, you'll see that for this part of the question, remember reviewing the question for 1.2. So reviewing the question for 1.2, remember for 1.2 they say, is there an arbitrage opportunity? That was the first part of the question. And if yes, show what step needs to be taken to make the arbitrage profit as well, and authorized to work with this amount as well, right? So if you check on the lecturer's memo, the first part of the question, the lecturer also showed how to address the issue of the arbitrage opportunity, and they say because the interest rate parity is not holding, there is an arbitrage possibility. Because 1.1025 is less than 1.0264, we can say that the CHFI interest rate quote is more than what it should be as per the quotes for other three variables. Equivalently, we can also say that the dollar interest rate quote is less than it should be as per the quotes for the other three variables. Now, from there, then they say, so therefore, the arbitrage strategy should be based on borrowing in the dollar market and lending in the CHF market. Because remember, you're borrowing, the one way there's a lower value is where you're going to be borrowing. And the one way there's a higher value is where you're going to be investing in that case. But whatever you do on one currency, you do the opposite in the other currency as well. So now the lecturer shows the steps that are going to be taken there. And then eventually we got to the profit of this, which is exactly as well what we got as well. So can we move on to the next question, which is question 2? Any question on question 1 before we move on to question 2? All right, moving on to question 2, they give us that information. So they give us that information, and then they say, calculate the net payoff at the following spot exchange rates. Now, when you do a calculation, as we see on questions for question number 2, make sure that you are putting them, your values are basically, they're either all in cents or they're all in dollars as well. So you cannot have some values in cents and some values in dollars. As you can see, the premium that is stated here is given in cents, which means that we need to convert that into Australian dollars. So which means from the given information, from what they give us there, since the premium is given in cents, our premium in dollars is equivalent to into a or premium is equals to 0.5 over 100, and 0.5 over 100, because remember, if you're not converted into dollars, in this case, it's going to be from cents to dollars, you're going to say 0.5 over 100, and you get a figure of a UD 0.005. So you get a premium in Australian dollars, which is equivalent to 0.005. Now, remember they say the option clause allows the holder to buy US $100,000 at an exercise exchange rate of that. And if the premium paid is that, calculate the net payoff at the following spot exchange rate. So we're dealing with the call option, isn't it? Now, by definition, we know that a call option it gives the holder the right, but no obligation to buy. So it gives the holder of the option the right, but no obligation to buy. I know that they say to buy at a stated price or over a given period of time. The more extended that part of the definition, it gives the holder the right, but no obligation to buy at a given price over a given period of time as well. So, by the main thing there, it gives the holder the right, but no obligation to buy, isn't it? So, if it gives the holder the right, but no obligation to buy, it means the holder only exercise their option when it's beneficial to them. So the holder only exercises their option when it is beneficial to them, right? So which means in this case, if they only exercise their option when it's beneficial to them, now we need to find out exactly. So how do we now determine whether they're going to be exercising their option or they're not going to be exercising their option? So which means when you now look at the value of the option, we say that the value of the option, the value of the call option is given as the maximum of 0 or spot price minus exercise price. So it's the maximum of 0 or spot price minus exercise price. So that's basically how you value an option. It's the maximum of 0 or spot price minus exercise price. Now, what do we see from this relationship? It means remember you have the right but no obligation to buy, isn't it? So it's either you buy in the market or you buy according to the contract. Now, so when are you going to buy according to the contract? You buy according to the contract when the price in the market is higher than the what? Contract price. Because remember, this is the contract price and this is the price in the market. So you exercise that right when the price according to the contract is higher than the price not in the market. So that's when you are going to be exercising that particular right. So you exercise the right when you buy according to the contract. When you exercise that particular right when you see that the price in the market is higher than the price of the contract, which means that it's beneficial to you to buy according to the contract because the price according to the contract is what? Is lower. So, which means in this case, there are two things that are going to happen. It's either you're going to exercise your right or you're not going to exercise your right. So when do you exercise your right? You exercise your right when the spot price is greater than the exercise price. That's when you exercise your right. Now, if you exercise the right when the spot price is greater than the exercise price, so what does mean? What does that mean becomes your payoff? Your payoff now will be equal to, okay, let me just make space here. So you exercise your right when the spot price is greater than the exercise price, which means your payoff in this case will be equal to, you are going to compare the spot price minus the exercise price. So you compare the spot price minus the exercise price. But remember, if you exercise that right, remember, for you to have the right but no obligation, to have that right but no obligation, you need to pay something. You need to pay a premium, isn't it? So which means the premium that you're going to pay is also a cost to you. So after you make this money per unit, you multiply that by the what? By the notional principal. So that's how you determine the payoff for call option. Are we on the same page? Any questions? Now, if you choose not to exercise, you choose not to exercise because the spot price is less than the exercise price, because you're saying the price according to the contract is too much compared to what other people are buying at. Because remember, you have the right to buy. So because you have the right to buy, you're basically saying that if I buy according to the contract, I'll be paying too much money compared to other people in the market. So I'd rather go and buy in the market, which means I'd rather walk away from the contract. So if you choose to walk away from the contract, what's going to happen? It means your payoff in this case will be equal to, you lose out on the premium that you've already paid because you're going to walk away from the contract. But remember, you pay this premium per unit of currency, isn't it? Which means you need to multiply that by the what? Notional principal of the foreign currency that you want to buy in this case. Are we on the same page? Any questions? So which means in this case, for the first part of the question, they are telling us that the spot price, for the first part of the question, they are telling us that the spot price is 1.80 or 8040. Remember, they are telling us as well that the exercise price is 1.80, isn't it? So are we going to exercise that option, or are we not going to exercise the option? Are we going to exercise the option, or are we not going to exercise the option?
Exercise.
We are going to exercise because the spot price is greater than the what?
Greater than
Exercise
the
price, isn't it? So we are going to exercise this option. And as we are going to exercise this option, it means our payoff in this case is going to be the stated spot price in this case, which is an amount of 1.8040 minus the exercise price of 1.8 minus the option premium of 0.005 multiplied by that, by the notional principal, which is the number of units of the foreign currency that we want to buy, which is 100,000 units of the foreign currency. So in this case, how much is going to be our payoff in Australian dollars?
a negative 100.
A negative 100,000. A negative 100. So we're going to lose out, isn't it? Someone might ask, why are we going with this contract when we're still going to lose, isn't it? Now, if you compare us losing $100, let's see if you were to walk away from the contract. If you were to walk away from the contract, isn't it? Your payoff was going to be the premium multiplied by the notional principal. So if you say the premium of 0.005 multiplied by the notional principal for 1 million, you see that we would have lost out on what? 5,000 Australian dollars. So we are better off losing only $100 Australian dollars than losing what? 5,000 Australian dollars if we walk away from the school. Are we on the same page? Any questions? Then for the next part of the question, what view of the question? Remember the view of the question, the spot price is 1.8260. So are we going to exercise this option or are we not going to exercise this option? Are we going to exercise the option? We're going to exercise it. So if we exercise this option, it would mean our payoff would be the spot price of 1.8260 minus the exercise price of 1.8 minus the premium of 0.005 multiplied by 100,000. Sorry, is it 100,000? Yeah, 100,000. So how much would be your payoff here?
$2,100 Australian dollars.
Positive or negative?
Positive.
Positive. So we make a gain. All right. Then on the next scenario, which is part C of the question, they tell us that if the spot price is 1.7870, are we going to exercise this option or are we not going to exercise the option?
Not exercise.
So we choose not to exercise the option. So if we choose not to exercise the option, the payoff is going to be our premium plus the notional principal, isn't it? So it's going to be our payoff is going to be equal to minus the premium of 0.005 times the notional principal of 100,000 units. So how much is our payoff in Australian dollars?
Negative 500.
Negative 500. Okay. Next part of the question, they say, at what exchange rate will the holder break even? So at what exchange rate will the holder break even? Now for the core option premium, the break-even point is given as the exercise price plus the core option premium. So the break-even point is given as the exercise price plus the core option premium. So which means in this case, our break-even point would be equal to the exercise price of 1.8 plus the option premium of 0.005. So what would be the break-even exchange rate?
1.8050.
1.8050 Australian dollars. So it will be 1.8050 Australian dollars. Are we on the same page when it comes to this part of the question? Any questions? So if you check on the lecturer's memo, you see that for the first one, yeah, we also got 100, but remember these are Australian dollars. You've got 2,100, you've got minus 500, and then we have 1.8050 as well, which are all in Australian dollars as well. For the second part of the question, which is 1.2, we are now dealing with put option. For the second part of the question, we're dealing with put options, and they give us that information. And they say calculate the net payoff at the following spot exchange rates. So for 2.2, remember the first thing that we said we need to do, we need to make sure that we're dealing with things in the same notation, which means that if the premium is given in cents and these exchanges are given in Australian dollars, we need to convert everything to what? To Australian dollars. So for question 2.2, we say is equals to 0.4 over 100, which will give us 0.004 Australian dollars. So it gives us 0.004 Australian dollars. Now, when it comes to the put option, the put option gives the holder the right, but no obligation to sell. So it gives the holder the right, but no obligation to sell. So it gives the holder the right, but no obligation to sell. So which means in this case, we're basically saying that I want to sell, but I'm worried about price going down. So I'm going to go into an option contract, which gives me the right to buy when it's to sell when it's beneficial to me, and I'll only exercise that right when I see that it's what beneficial to me as well. So which means in that case, when you look at your decision tree, it means we're going to say it's either you are going to exercise that right or you're not going to exercise that right. Now, at what point do you exercise that right? Remember, you are the one who's selling it. So which means in this case, if the exercise price is greater than the spot price, that's when you're going to exercise that right, because you're saying, I'm selling at a higher price according to the contract compared to other people in the market. So that's when you exercise that right. And you choose not to exercise that right when you see that your exercise price according to the contract is less than what you can get if you sell this asset in the market. So you are better off walking away from the contract and going to sell in the market. So which means in that case, if you choose to exercise that right, your payoff is going to be equal to you exercise the right when the exercise price is greater than what? The spot price. So this is going to be your benefit or your profit. But now, for you to have that right, but no obligation, you need to pay a premium. So which means in this case, your payoff here or your profit here is going to be reduced by the what? Premium that you're going to pay. Now, over and above this as well, remember if this is your payoff per unit, it means you're going to multiply that by the notional principal to see your total net payoff. Are we on the same page when it comes to the put option? Any questions? Then if you choose not to exercise your right, your net payoff in that case would be equal to, if you choose not to exercise the right, you're going to walk away from the contract. And if you walk away from the contract, you lose out on the premium that you pay. But this is your loss per unit, so which means your loss is going to be compounded by the number of units that you are entering into the contract on. So which means in this case, for part A of the question, remember so for part A of the question, they tell us that remember all the information that they give us, they tell us that the exercise rate is 0.19. Now, the spot rate is 0.20. So are you going to exercise your option or are you not going to exercise your option? Remember we said you exercise your option when the exercise price is greater than the what? Spot price. When you're selling at a higher price according to the contract compared to other people in the market. So for part A, are you going to exercise the option? So are we going to exercise the option?
Not gonna exercise.
So we are not going to exercise the option because our exercise price here of 0.19 is less than 0.2, is it? So we are not going to exercise the option, which means if we don't exercise the option, we walk away, which means our net payoff is going to be the loss on the premium of 0.004 multiplied by the notional principal, which is the number of units of foreign currency. And in this case, it's 250,000. So how much is your payoff?
-1,000.
-1,000. Okay. Are we together? Any questions? Moving on to part B of the question. For part B of the question, they say if the spot rate is 0.192, do we exercise this option or do we not exercise the option? Do we exercise this
No.
option or do we not exercise the option?
Not
Please,
exercise.
we don't exercise the option. Because remember, the exercise price is less than the what? The spot price is. So we are not going to exercise this particular option. So which means if we don't exercise this particular option, our net payoff is going to be the loss that we're going to be having on the premium, which means it's going to be minus 0.004 multiplied by 250,000, which is going to be minus. Moving on to part C of the question. For part C of the question, they tell us that the spot price is 0.18. So are we going to exercise this option or not?
Exercise.
So we are going to exercise the option. And if we choose to exercise the option, it would mean that our payoff is going to be equal to the exercise price of 0.19 minus the spot price, which is 0.18, minus the option premium, of 0.004 multiplied by the notional principal of 250,000. So how much is going to be the payoff?
$1,500 positive.
Positive, 1,500 positive. Are we on the same page? Any questions? Anyone lost? The next part of the question, they say, at what exchange rate will the holder break even? So they're asking us at what exchange rate will the holder break even? So which means to get the break even point, we're going to say the break even point is given as the exercise price minus the put option premium. So the break-even point would be the exercise price minus the put option premium. So which means in this case, for part D of the question, the break-even point is equal to the exercise price of 0.19 minus the put option premium of 0.004. So what would be the break-even point in this case?
$0.1860.
So 0.1860, that would be the break-even point. So that is the break-even exchange rate. So if you check on the lecturer's memo, for the first one, the net loss is 1,000, and the second one is also minus 1,000. The loss is 1,000. The third one, it's a profit of 1.5, and the break even is 0.1860. Yeah, so we have exactly the same amounts. Are there any questions on what we've done so far on question 2? Any questions? All right. Can we take a few minutes break until 9:30? Can we take a few minutes break until 9:30? Then at 9:30, we move on to question number 3. So can we take a few minutes break until 9:30? Then at 9:30, we move on to question number 3. Is there any questions on what we did on question 2 before we move on to question 3? Any questions? All right, moving on to question 3. Question 3, they give us that information. Question 3, they give us that information. And for question 3.1, they say, calculate the net present value in ZAR using the ZAR equivalent cost of capital according to the Fisher effect, and then convert the US dollar at the current spot rate. Now you see that the method that we used, the answer that we got is slightly different from the lecturer's answer, mainly because the lecturer was not rounding off the in-between calculations for each section. They were just putting all the answers in memory and then doing the calculation all at once as well. So I just want to check with you guys, how much did you get as a mark for question 3.1? How much did you get as a mark for question 3.1?
3.1, I think I'm seeing ticks.
Yeah, but how much are they amounting to? Because each tick is a mark, right?
Okay, 1, 2, 3, 4, 5, 6, 7, 8.
Okay,
I'm
so it's
seeing
5.
8 ticks.
Yeah, because you see on the lecturer's memo, is the amount that is getting there is exactly 1.7 million. But the method that we're basically using is the same. But the only difference there is that when it's doing the calculation, I'm sure that he's storing all the values in memory. And when we do the calculation, we are rounding off each part of the calculation. We are doing the calculation separately, then adding them up together, and then converting them at the spot rate. So you see that the answer is not going to be exactly 1.7 million. It's going to be something close to. Because if you check on our memo, you'll see that for our answer for question 3.1, we got this, and then when we converted this at the spot rate, we got about 1702 something, which is not exactly 1.7 million. That's why I was checking to see how much you got, which means if we got 8 out of 9, it means that he's basically saying that the method that we're using is correct as well. So you'll see that looking at this, remember we said, remember the first part of the question, they're asking us to say, calculate the net present value in ZAR using the ZAR equivalent cost of capital according to the Fisher effect, isn't it? Right? That's the first part of the question. Now, for the first part of the question, when you're calculating the net present value in ZAR, what they're asking us to do is that you need, if for you to get the net present value, if they're asking for the net present value in ZAR, it means your cost of capital has to be in ZAR, and your cash flows also have to be in ZAR. So your cash flows and your cost of capital always have to be in the same currency. So your cost of capital and your cash flows have to be in the same currency. So if they're asking for the net present value in ZAR, it means your cost of capital has to be in ZAR and your cash flows have to be in ZAR. And as you can see, the cash flows that they're giving us here are in ZAR, but when it comes to the cost of capital, they say the parent firm's cost of capital in dollars is 9.5%. So which means we need to find the equivalent ZAR cost of capital. So we need to find the equivalent ZAR cost of what? Capital, so that we make sure that the cash flows are in ZAR, and then the discount rate is also going to be in ZAR as well. So to using the Fisher effect, To find the equivalent cost of capital in ZAR, we are going to say the ZAR equivalent cost of capital is given as 1 plus cost of capital in the foreign currency multiplied by 1 plus giving us the interest rates, inflation rate. 1 plus inflation rate in the home currency divided by 1 plus the inflation rate in the foreign currency. So this is basically how we find the ZAR equivalent cost of capital. Then we say minus 1 after we do this. Then we say minus 1. So this is how we find the ZAR equivalent cost of capital. And remember, the ZAR in this case is the domestic, what you're deeming to be the domestic at that point. So which means, given this formula, the ZAR equivalent cost of capital is going to be equal to, remember on the question, they tell us that the cost of capital in the foreign currency is given as 9.5%, so it's going to be 1 plus 0.095 multiplied by 1 plus the inflation in the home currency, which is in South Africa, is 7%, so it's 0.07. And the inflation in the foreign currency is 3%, which is 0.03. Then minus 1. So how much would you get as the ZAR equivalent cost of capital? How much do you get? You must be able to get a figure of 13.75%. Remember, this is 1.095 multiplied by 1.07 divided by 1.03. You get your answer, then you say minus 1. Then whatever answer you get, you need to multiply that by 100 to make it a percentage. And you should be able to get 13.75%. Are we on the same page? Any questions? So what do we see? Our cost of capital is in ZAR, and our cash flows are already in ZAR. So given this information, now remember they're asking us to find the net present value in ZAR, isn't it, right? So which means the net present value in ZAR, to find the present value, remember we say your present value is given as your future value in brackets 1 plus the interest rate to the power of t. So this is how we find the present value. So the present value is given by that formula, which means to find the value of our investment, the net present value, what do we see? It means I'm going to say your net present value is given as the present value of expected future cash flows minus initial investment. So the present value of expected future cash flows minus initial investment. How do we find the present value of these expected future cash flows? we need to discount all these cash flows back to present value by using that formula. So which means in this case, our net present value is equal to.
Sorry, Rhinos.
Yes.
Can you please explain the first calculation? Are we trying to find an inflated an inflated cost of capital? The purpose of the first calculation.
What we're trying to do is that, remember, we're given the cost of capital in dollars, isn't it? It's 9.5%. So our aim, whenever they ask you to find the net present value in a certain currency, it means your cost of capital has to be the same currency and your cash flows have to be in the same currency as well. So which means if you check on the question, they are asking us for the net present value in ZAR, isn't it? So which means we need to make sure that our cost of capital is in ZAR and our cash flows are in ZAR. On all the information, the cash flows are already in ZAR, but the cost of capital is in what? Is in dollars. So we need to convert, check to see exactly what is the, given that there is an inflation relationship between exchange rates. This adjustment is just trying to show that the movement in exchange rate is based on the relationship between the inflation, the change in inflation between the two currencies. So which means using the inflation relationship between the two currencies, we can be able to convert the cost of capital from one currency to another currency, because we're basically saying that the exchange rates are determined by the what? Movements in change in inflation, basically. Are we on the same page? Are you answered?
Yes, I'm answered. Thank you.
Okay. Please put your microphones on mute. Please put your microphones on mute. So which means now, to find the present value of expected future cash flows, we're going to say the first cash flow is the cash flow for year one, which is given as 3 million. So it's going to be 3 million divided by 1 plus the interest rate in ZAR, which is 13.75%, which is 0.1375. This is to the power of T. Remember this cash flow, you are receiving it after 1 year. So we're discounting back for 1 year. So it's just to the power of 1, which remember, any number to the power of 1 is that number. Any number divided by 1 is that number. Any number multiplied by 1 is that number as well. So it won't make a difference. Plus, the second cash flow for year 2 is equal to 4 million. So we have to discount it back to present value. So which means it's going to be 0.1375 to the power of 2, plus the next cash flow is 5 million. And this is going to be discounted for 3 years. The next cash flow is 6 million. And the last cash flow is 7 million. Then minus the initial investment, which is 10 million. And how much do we get as the net present value in ZAR? Please note, like what I said, another easier, when it comes to showing your working, what you can do in the exam, when it comes to showing your working, you can show this working there, right? But when it comes to the calculation, the easier way of doing this particular calculation is if you enter these cash flows in your calculator as well. That's the easiest way to deal with this particular calculation, which means if you're using the sharp calculator, you can now say you first enter the cash flow for year 0, isn't it? Remember, when you're using the sharp calculator, you always have to make sure that you clear your memory. And how do you clear your memory? You say shift alpha 00. You have cleared your memory, right? Then you now need to enter the cash flows from period 0 all the way to the last period. So which means with the sharp calculator, I'm going to say 10 million. It's a cash outflow. So you press the plus minus button and then you press enter. Then from there, 10 million, eh? 10 million, then you enter. Then you press enter there. Yeah. Then there you're going to say 3 million. It's a positive cash flow. So you just press enter. Then 4 million. Press enter. 5 million. Press enter. 6 million. Press enter. 7 million. You press enter. Then you press second function, and then you press CFI. Remember, the interest rate is 13.75%. So you're going to say 13.75, and then you press enter. You scroll down, and then you press compute. So that's how you determine. That's the quickest way to determine the net present value. And if you're using the HP calculator, you're going to say 10 million plus minus button, and then you press CFI. Remember to play your memory with the HP calculator. You're going to say shift, then you press C or CO, because you're trying to cancel everything in memory. Then from there, you need to enter the cash flow. So you're going to say so it's supposed to be CFJ here. Then 3, 4, 5. Yeah. Then you need to enter the interest rate. So we're going to say 13.75. You press the interest per year button, and then shift. Then you look for NPV. So how much do you get as the ZAR net present value? How much do you get as the net present value? How much do you get?
$6,385,458.51.
0.51. Okay. Are we getting the same amount? Anyone struggling to get the answer? Anyone struggling to get the answer? So our ZAR net present value is this much, right? Remember the second part of the question, they were also asking us to find the net present value, then converting the year to US dollar at the current spot rate as well, right? So which means in this case, the net present value in US dollars would be given as we have 385,458.51 units of the ZAR. And remember, our exchange rate is given as a rate of the spot exchange rate is given as 3.75 ZAR is equals to $1. So 3.75 ZAR is equals to $1. So now, looking at the exchange rates there, we are moving from the ZAR going to the US dollar. So are we going to multiply or are we going to divide? Get to the US dollar. Do we multiply or do we divide? Do we multiply or do we divide? We divide, right? Because remember, we are moving from the weaker currency going to the stronger currency. So if you're moving from the weaker currency going to the stronger currency, you end up with what? Less units. So to end up with less units, it means that in this case, we have to divide by the exchange rate of what? 3.75. So in this case, how much would be the net present value in US dollars?
Nine.
How much?
1,702,788.94.
94.
Yes.
Okay. Are we on the same page? Any questions? Anyone lost? So if you check with the lecturer's memo, you see that for 3.1, the lecturer got exactly 1.7 million. But if you look at the method that he used, it's basically the same thing. The presentation is the same. And the conversion or converting at 3.75 is the same as well. So the lecturer got exactly 1.7 million. I'm not sure exactly how we got the exact figure, but I don't think we'd be penalized because our answer is exactly very close to it. And at the same time, the difference there is because of the issue of rounding off as well. Can we move on to question 3.2? For question 3.2, they give us that information and then they say, calculating the net present value, converting all cash flow from ZAR to US dollar at purchasing power parity forecasted exchange rates, then calculating the net present value at the dollar cost of capital. So they're asking us now to convert our cash flows to US dollars and then calculating the net present value at the dollar cost of capital as well. Remember, if they're asking us to find the net present value in dollars, it means our cost of capital has to be dollars and our cash flows have to be in dollars. So which means from the information that we have, our cost of capital is already given in dollars at 9.5%. Now, our cash flows are the ones that are what? In ZAR. So we need to convert these cash flows to dollars, then find the net present value using the dollar cost of capital. How much did you get for question 3.2? How much were you allocated? Because the lecturer used a direct method where he basically mashes everything up together in one calculation and then directly do the calculation. And what we did was, our first step was to find out exactly how much is the exchange rates, estimated exchange rates. Then from the exchange rates, we determined the cash flows. Then after the cash flows, that's when what looked at the net present value as well. But the lecturer, basically, what the lecturer did for this particular question is that if we check on question 3.2, he basically just put everything all in one. He basically just put everything all in one. So he estimated the exchange rates, and then immediately after that, he basically just mashed up everything together. Instead of converting these cash flows to ZAR, he just did it in one calculation as well. But usually, I avoid this method mainly because some students, I'm afraid that some students might get lost in understanding exactly why are they doing what they're doing. Because sometimes instead of dividing by that amount by the exchange rate, what if you're moving from the stronger currency to the weaker currency where you're supposed to be multiplying, you end up getting confused. So rather do everything step by step, convert the cash flows first, then deal with the converted cash flows using the formula directly instead of what mashing up everything together. That's what I always prefer. So that's why I'm asking you to say, so what is the lecturer saying? How much did you get as mark allocation for question 3.2?
I got 11.
11 is fine because remember it's out of 12, isn't it? So I'm sure they avoid just giving you all the marks, which means everything that we did was fine then. So we can just use and continue with our method. Because the method of mashing up everything together, I have issues with it where you are not sure where, you get lost in the calculation exactly. Why are you doing what you're doing as well? Where if anything changes in that calculation, you get lost in because you're not sure whether you should be dividing and then which formula are you supposed to be using as well. So rather deal with knowing that first, I'm estimating the exchange rate. Secondly, I'm determining the equivalent cash flows. And then lastly, I'm just determining the net present value so that if you mash everything together, if anything changes there, you get lost in your calculation. That's what I'm afraid of. So which means the first thing that we need to do there is to estimate the exchange rate using the purchasing power parity. So the first thing that we need to do is to estimate the exchange rate using the purchasing power parity. So now to estimate the exchange rate using the purchasing power parity is that we're going to say the purchasing power parity estimated exchange rate is given as the spot rate is given as the spot rate multiplied by 1 plus the inflation in the home currency divided by 1 plus the inflation in the foreign currency, and this is going to be put to the power of t. So that's how we're going to estimate the exchange rates. So which means our spot rate for period 0 is given as it's already given to us as 3.75. Now we need to find out exactly what is the spot rate, spot exchange rate at period 1. So to find the spot exchange rate at period 1, we're going to say, remember, from the information that they give us there, they already tell us that the inflation in South Africa, which is the home currency, is 7%, and in the US, which is the foreign currency, is 3%. So it's going to be 3.75 multiplied by, to make your life easier, you're just going to say, remember, it's, okay, I'll make it clear. 1 plus the inflation in the home currency, which is 7%, so it's 0.07, divided by the inflation in the foreign currency, which is 3%, is 0.03. And this is going to be put to the power of 1 because it's after one period. Please note that to make your life easier in this calculation, remember 1 plus 0.07 is just 1.07. 1 plus 0.03 is 1.03. So which means if you now say on your scientific calculator, if you say 3.75 multiplied by open brackets, so 3.75 multiplied by open brackets, 1.07 divided by 1.03. Then you close brackets. Then you say to the power of by pressing X. Remember you put something to the power of by pressing X with a Y on top, isn't it? Then you say to the power of, the only thing that you now need to do is if it's in the first year, you just press 1 and you get your answer. So how much do you get as the exchange rate in the first year? How much do you get?
3.90.
So you get 3.90. Now, after you do this, to get the spot rate in the second year, remember it's going to be 3.75 open brackets 1.07 divided by 1.03 to the power of, for the second year, it's going to be the power of 2. So which means on the previous calculation that you did there, the only thing that you have to do now is just backspace, remove the 1, put the 2, put to the power of 2, then you say equals 2. It becomes easier now to quickly get the exchange rates. So how much do you get?
4.05.
4.05. So you see that if you use this method, it's easier for you to get the spot rates all the way up to year 5. Because for year 3, you're going to say and you should be able to get a figure of 4.20. And then for year 4, and you should be able to get a figure of 4.37. And for year 5, you should be able to get this. Are we all coming right with the issue of the exchange rates? Any questions? Now, the next step, remember we already have the cost of capital in dollars, isn't it? Now we need to find out exactly what is the cash flows in dollars as well. So which means to find the cash flow in dollars, we're going to say the cash flow in dollars for period 0. So just simply say in dollars. So the cash flow for period 0 is going to be equal to, for period 0, we are told that we are spending 10 million. And remember, this is going to be divided by the exchange rate of what? 3.75. So how much do you get as the cash flow in dollars? How much do you get? are you getting? Minus 2,666,666.67. Are we getting the same amount?
Yes.
All right. Then we determine the cash flow for period 1, and your cash flow for period 1 is going to be equal to, for period 1, we are told that we have a cash inflow of 3 million. So it's going to be 3 million divided by the exchange rate of 3.90. And if you do the calculation there, you must be able to get a figure of 769,230.77. Then your cash flow for period 2 would be 4 million divided by the exchange rate of 4.05. And you get 987,654.32. And then your cash flow for year 3 would be, for year 3, the exchange rate is 4.20. And you get a cash flow of 6 million. And for year 4, your exchange rate is 4.37. And you get 1,372,997.71. And then your cash flow for year 5 would be 7 million over, remember for year 5, the exchange rate is 4.54. Which will be equal to 1,541,850.22. So these are the cash flows in US dollars. So now we have the cost of capital in US dollars and we have the cash flows in US dollars. So we can go ahead and calculate what the net present value is, which means in this case, the net present value is going to be equal to, remember, is the present value of expected future cash flows minus what? Initial investment. The first future cash flow is 769,230.77 divided by 1 plus, remember the cost of capital in US dollars is 9.5%, which is 0.095. Remember, this is to the power of 1. The second one is 987,654.32 divided by 1 plus 0.095 to the power of 2. And the next one is 11,476.19 divided by 1 plus 0.095 to the power of 3 plus. The next one is 1,372,997.71 divided by 1 plus 0.095 to the power of 4 plus. The next one is 1,541,850.22 divided by 1 plus 0.095 to the power of 5 minus the initial investment of 2666,666.67. So given this information, how much do you get as the net present value in US dollars? How much do you get as the net present value?
$1,700,719.91.
Okay, I got 720.32, but it's close to it. It's very close. It's a small issue of rounding off. Are we on the same page? Anyone lost? Is anyone lost? Now, for question 3.3, for question 3.3, for question 3.2, if you check on the lecturer's memo, you'll see that we estimated the exchange rate there, and then the lecturer just puts everything all at once, and then they say the amount is exactly 1.7 million US dollars. So in this case, they say the $2 net present values are identical, as they always would be under the assumption that both purchasing power parity and the Fisher effect hold. Note that both parity conditions incorporate relative differences, not in inflation as well. Now, moving on to question 3.3, they are telling us that the actual exchange rates are as given. So now, given these actual exchange rates, now we need to find out exactly, so what is the net present value of this quantity, given these actual exchange rates? So given these actual exchange rates, the first thing that we have to do is to convert the cash flows into US dollar equivalent cost of capital at the given actual exchange rates. Then we now need to find what the net present value. So what we see, the spot rate does not change, isn't it? The spot rate does not change. It remains the same because we know with certainty how much we can convert the ZAR currency into an equivalent amount in ZAR today. We know immediately, we know exactly how much we'll get it for. But what we don't know is the exchange is going to be after 1 year, after 2 years. But now they're telling us what the exchanges are. So which means in that case, your cash flow in dollars, your cash flow in period 0 is not going to change. It's going to remain at minus 2,666,666.67. It's not going to change. But now our cash flow for period 1 is going to change because the exchange rate is going to be different. So we have a cash flow in ZAR of 3 million, but the exchange rate is now 5.7. So how much is the cash flow in dollars? How much do you get as the cash flow in dollars? How much do you get?
For year 1, 526, 315.79.
0.79. Yeah. So you do the same going all the way up to what? Year 5. So which means your cash flow for year 2 would be 4 million over the exchange rate is 6.7. And you should be able to get an amount of 597,014.93. And then your cash flow for year 3 would be 5 million over the exchange rate in year 3 is given as 7.2, which means in dollars is going to be 694,444.44. And then your cash flow in year 4 will be equal to 6 million over the exchange rate of 7.7. You get 779,220.78. And then your cash flow for year 5 will be 7 million divided by the exchange rate of 8.2. And you get 853,658.54. Now that we have the cash flows in dollars, according to the actual exchange rates, and we have the cost of capital, which is already given in dollars, is 9.5%, we can now calculate what the net present value. So your net present value in this case is going to be, for the first year, is going to be 526,315.79 over 1 plus 0.095 to the power of 1 plus the second year, 597,014.93 over 1 plus 0.095 to the power of 2 plus next one is 694,444.44 divided by 1 plus 0.095 to the power of 3, and the next one is 779,220.78 divided by 1 plus 0.095 to the power of 4, plus the next one is 853,658 then minus the initial investment of. So given this information, how much do you get as your net present value? How much do you get?
$74,869.23.
So you get, it's a negative, right?
Yes, it's a negative,
Minus
sorry.
748.
869.
Is it 69 or 896?
Oh, 896, sorry.
896.23.
0.23, yes.
So that will be your net present value. Are we on the same page? Any questions? Anyone lost? So what do we see? Because our exchange rate did not move as we anticipated according to the purchasing power parity, instead of having a net present value which is positive of this much, we actually ended up having what? A negative net present value, which also means, remember, the sign of the net present value is very important because it also determines the acceptability of the project. If the project has a positive net present value, it's acceptable. And if the project has a negative net present value, it should what? Be not accepted. Which means in this case, the movements in exchange, the actual movements in exchange rates made the change the project assessment from being acceptable to not to be acceptable. Because the exchange rate did not evolve as we anticipated according to the what? Purchasing power parity. Are we on the same page? Any question? So if you check on the lecturer's memo, for question 3.3, you will see that the lecturer says, given this information, your net present value is minus 75,000 exactly. And then they say the net present value is negative because actual exchange rates did not evolve as forecasted by the purchasing power parity. So consequently, actual net present value and forecast net present value may be different. Are we on the same page? Any questions on what we covered in assignment 1 when we're reviewing assignment 1? Any questions? So please take note. In the next class, we're going to be reviewing assignment 2. Once we are done reviewing assignment 2, the question is going to be open-ended, where if there's anything that you come across when you're doing revision, we are going to be doing it. If there's anything that you still don't understand from the textbook, we're going to be looking back at it and explaining it in more detail as well. So please, if there's anything that you come across when you're doing your revision and you found it difficult and you need to have the explanation, please send me a picture or make me send me a reference of exactly where the material is, so that as soon as we're done reviewing assignment 2, we can now what? Go on and what? Start polishing up. Are we on the same page? Any questions? Anyone lost? All right. If there are no questions, enjoy the rest of your Sunday.
Sorry.
Yes.
Yes. Can we do 1 or 2 previous question papers after we've done the assignments?
Which previous question papers?
Maybe 2022, 2023.
We've already done them.
Oh, okay.
Yeah, we have already done them, because when you look at when I check on the database of question papers, if you check on the website, right, when you log in, when you check on the website, you see that all the videos for the question papers going through all the previous years up to May, June 2023, they are there. So what I would advise you to do, go through those videos, and then when you go through those videos, if there's anything that you don't understand, send me a WhatsApp message. I'm always available. I can always respond as well.
Okay, thanks.
So please just go check on the videos that are available, because it's the first thing that we did when you started revision. So please go through those videos. If there's anything that you don't understand, please let me know. All right. Enjoy the rest of your Sunday.